The Thrift Savings Plan is a 401k retirement fund for federal and government employees. The TSP has some of the lowest fees on any 401k I've seen. Some funds have started to do zero fees, but we'll see how that works out. My favorite benefit of the Thrift Savings Plan is that it's 99% passive. All you need to do is log on to MyPay and set what percentage of your paycheck you wish to contribute. After setting the allotment for monthly contributions, you need to verify in which fund your money will be deposited. I will go into more detail on specific funds and allocations in a few minutes. There are two different types of 401k plans that you can utilize with the TSP. They each have their advantages. There's the traditional 401k and the Roth. With the traditional, you don't pay taxes when you contribute, but you'll pay taxes when you withdraw your funds. While in contrast, the Roth 401k means that you pay taxes when you contribute, you won't pay taxes when you withdraw your funds. So what does this mean for you? With the traditional 401k, you are able to write off any income you place directly into the 401k. By reducing your taxable income, you are able to invest more money into the TSP initially. Downside to this is that your 401k will be taxed as ordinary earned income when you begin withdrawing money from it, and there will be more money in it because you were able to contribute at a higher amount, but then again, you'll pay taxes on it. The Roth 401k, on the other hand, is funded with after-tax dollars. This means you put less money into the 401k initially, but none of it will be taxed upon withdrawal. Each of these funds has their own advantages, but the easiest way I can think to help you decide which to use is to answer this question. Do you expect to be earning more or less income in retirement than you currently are? If you plan to retire with a larger income, pay the taxes now with the Roth. If you believe you're earning more income now than you will in retirement, pay the taxes later with the traditional. Now, the blended retirement system. A lot of people are frustrated about the new BRS, but let me show you how awesome this can be for young service members. The dollar value of 5% matching contribution is $178.19 per month during your first year of service if you're in E1. These numbers only include the matching contribution and do not include your 5% contribution. For the sake of simplicity, we're going to assume that you do not ever receive a pay raise during the first 4 years, even though you'll get one every year. This $178.19 becomes $8,553 over the next 4 years. As a side note, that's not including the interest accrued during this period, just the amount contributed. In 40 years, that dollar amount will have grown to $128,078 if you received an average of 7% returns during that time. If you had placed the money in a more aggressive fund and received an average of 10% return, it would grow to $387,000 and some change. Now here's the crazy part. Having $387,000 in your TSP equates to about $1,290 a month in withdrawals at a 4% withdrawal rate, which is recommended, or $15,484 annually. Keep in mind, this assumes that you only contribute to your TSP for 4 years and did not stay in the military. Imagine if you kept contributing for your entire 20-year career, plus the 5% that you are actually contributing. If you stay in the service for 20 years and you retire as an E8, which is about the average, your retirement check is currently $2,500. But if you go with the BRS route, which you all have to now, this will drop to $2,000. But once you add the additional $1,290, assuming you stop contributing after 4 years, in your 60s, you will be doing much better. The other major benefit of the BRS is that you can exit the service after 4 years and take this $8,500, which could grow to hundreds of thousands of dollars, with you. That means the additional $1,200 or whatever it grows to a month at retirement will still be yours. The old retirement system, you would have received nothing towards retirement other than your personal contributions after 4 years of service. It's important to note that the figures above refer only to the 5% contribution, which means you have an additional 5% that you would have contributed and then anything else on top of that, which is why I recommend 10%. In fact, let's get crazy for a moment. If you contribute 25%, so 20% plus the 5% matching, for 4 years, again assuming no promotions or interest, you will have contributed $24,000. In 40 and a half years, when you go to retire, it will have grown to $512,000 at a 7% return, or $1.69 million at a 10% return. At a 4% withdrawal rate, this is $67,000 annually. If you contributed 35%, 30 plus the 5% match for 4 years, again, no promotions, no interest, you'll have contributed $32,000 at the end of 4 years. In 40 and a half years, it will have grown to $677,000 at 7% interest, or $2.24 million at a 10% return. At a 4% withdrawal rate, this is $89,000 annually. Basically, you need to maximize your effort in contributing to the TSP during your first 4 years of service. If you do this, your retirement could already be sufficiently funded at the end of your first term. Now, you would be able to begin investing the money you had been contributing elsewhere, like real estate. With the new retirement system, it is much more important than ever that you understand the various TSP funds where you can allocate your money. Traditionally, your money started in the G fund, which has never lost money, but only earns 1 to 2% interest, which is barely outpacing inflation, if at all. Unfortunately, a lot of us old guys, talking about myself here, didn't know this and left our money in there for the first few years, 5 years in my case. That means I missed out on a ton of interest during the early years of my service, which is the most impactful years for a high rate of return. Luckily, the blended retirement system, the matching portion, will automatically be placed in the Lifecycle funds, which is a much better scenario, and I believe that it is going to become the default allotment for everything. But make sure you verify what account your funds are going into immediately and change it to something like the Lifecycle or something more aggressive that you are comfortable with. There are so many different ways that you could allocate your funds. My opinion is that you should place all of your money into the Lifecycle funds for the year you plan to retire, if you aren't very savvy with various funds. If you plan to retire in the year 2053, then you would use Lifecycle Fund 2050. I suggest this because that fund shifts throughout time to provide the best return in the least likely manner for you. It will be more aggressive when you're younger, and as you get closer to retirement, it will gradually move a larger allocation to the G fund so that it won't be hurt by any market downturn. If you want to put money in other funds, feel free, but the simplest way to handle the TSP is to drop your money in the L fund, and in theory, you could do this and never look at or touch your TSP again until retirement. Now, I'm going to give you a brief list of the descriptions and objectives of the TSP fund, and this is from the actual TSP website. It is quite possible to obtain the 10% return that we've discussed. The G fund is government-backed securities, interest income without the risk of loss of principal. The F fund is government, corporate, and mortgage-backed bonds, mirrors Bloomberg and Barclays. The C fund is stocks of large and medium-sized US companies, kind of mirrors the S&P 500. The S fund is stocks of small to medium-sized companies, mirrors the Dow Jones Industrial Average. And the I fund is international stocks of more than 20 developed countries, which mirrors the MSCI and EAFE funds. The L funds, or Lifecycle, is invested in the G, F, C, S, and I funds, provide diversified portfolios based on your retirement age. These are the 3 strategies for TSP allocations that you need to know about. Please note that all of these numbers are based on the paycheck of an E1 with fewer than 2 years of time and service to date. As you get promoted and you receive the 2-year, 3-year, and 4-year pay raises, I hope that you will increase the amount you're saving, as discussed above. According to a survey conducted in 2012, the average rate of promotion across the Department of Defense looks like this. You get E2 at 0.7 years, E3 at 1 year, E4 at 2.3 years, and E5 at 4.5 years. There is also a pay raise at your 2-year mark, 3-year mark, and 4-year mark, and every other year for the remainder of your time in the military. According to this timeline, the average service member will receive an additional $1,219 a month in base salary by the time he or she exits the service. Imagine if you saved 100% of your pay increases. Even if you only saved 50% of all pay increases, you could be saving an additional $7,300 in just the last year. Here's an example of a mild strategy for saving and investing. This strategy is easy to stick to because it will leave you roughly $862 in monthly spending cash. I would personally recommend starting with the strategy only if you have large debts to pay off. In that case, use as much of your spending cash as possible to pay that debt off quickly, then upgrade to one of the more powerful strategies as soon as your debt is gone. As a side note, these numbers are also as an E1 with less than 2 years time in service. So I would recommend that at a minimum you put in 10% of your paycheck to your Thrift Savings Plan, plus 5% contribution, which is $342 monthly, $4,100 annually, not including interest. I would also put 10% of your base pay into your savings account, which is $163 monthly, $1,965 annually. That is a total put away of $505 a month, or $6,070 a year. Now, without including promotions, pay raises, or interest, as we've been doing this whole video, this is what you will have saved after your first 4-year enlistment if you do this strategy. The total value of your TSP will be $16,400. Total value of savings will be $7,800. And the total combined amount will be $24,280. As you can see, it is possible to save a decent amount of money with very little effort in your first term. Unfortunately, most service members blow their money on expensive, depreciating assets like the cars and motorcycles I bought. You can still enjoy these items without missing out on the opportunities to build wealth. Now, I would be much further along in life financially if I had understood this information and been able to take action on it during my first term.
We're going to talk through why and what the difference between the traditional and the Roth TSP is. Traditional TSP is what you start with. That is what automatically all your contributions go through. In fact, that's what the matching contributions from the government go through if you're with the blended retirement system. That means that you contribute to your TSP pre-tax, so before the money is taxed. And then when you withdraw funds 30, 40, 50, 60 years down the road in retirement, you will be withdrawing and paying tax, right? So you pay the taxes on the back end and you don't pay the taxes up front. So you contribute more up front because you're not paying the taxes up front, but then you pull less in the back end because you're paying taxes on that money when it comes in. Now, the Roth TSP and Roth IRA and Roth contributions are paid with pre or post-tax dollars, meaning you paid the taxes and then contribute on that money, but they're not taxed on the back end. So no taxes in withdrawal, except for like early penalties if you break some of the rules and whatever for tax advantages. But that's neither here nor there. Roth, you pay the taxes up front, so you contribute less up front, but you don't pay the taxes on the back end, so you pull more on the back end. Now, there's a lot of different schools of thought for which one is better. Because yeah, if you're paying with pre-tax dollars, that means your taxable income right now is a little bit less because you don't pay taxes on the money you contribute. So if you contribute $20,000 and you were making $50,000, then you're going to get taxed in a $30,000 bracket, which is a little bit less. But it means that on the back end, you're going to get taxed more, right? So what you need to realize or decide is if you think you're going to get taxed less when you're 60 than you do now. Here's a couple ways to think through that. The first is, do I think that I'm making more money right now while I'm contributing than I will be in retirement? So for me, most of my contributions were made while I was active duty, making $30,000, $40,000, $50,000 a year. Probably safe bet in my eyes that I think I'll be able to make more than $40,000, $50,000 a year in retirement. Therefore, I'm making more money in retirement, which puts me in a higher tax bracket, so it makes sense to pay the taxes now because I'm in a lower tax bracket. So you want to pay the taxes when you're in the lower tax bracket because it's less taxes that you will pay, less percentage of your paycheck, ordinary earned income, that you'll pay taxes on. So if you are a young enlisted service member or even an officer, the odds are that you will, if you do retirement right, you will make more money in retirement than you are right now, so you would prefer to pay the taxes now. Hope that makes sense. The other thought is whether or not you believe that there will be less taxes from the government 30, 40 years from now or more. I don't know about you, but I don't foresee taxes going down, and they might, but you never know, right? So it's kind of a conversation, it's not a political conversation, that's just something you need to be honest with yourself about. Do you believe that taxes will go up or down? Because if you're in a higher tax bracket and taxes increase, then you definitely don't want to be paying taxes down the road. You want to pay taxes now. If you think you're going to be in a lower tax bracket and that taxes are going to decrease, then maybe you pay the taxes down the road. For me, I would always rather prepare and bet that I will make more money down the road than I do now, and therefore pay the taxes up front. So I personally contribute to the Roth TSP. Now, as I said, the matching contribution, the 1% automatic and then up to 5% matching contribution from the government always goes to the traditional TSP. So regardless, you're going to put some money in the traditional, but once I learned that, and for the first few years, I contributed all to traditional. I also left it all in the G fund, which is another video, and I've made a bunch of them, but not the best idea, at least not at an early age. And so I made all of those mistakes. But now, once I started realizing all this stuff, I immediately moved my money into the Roth TSP. So I think I've, in my account, probably like 20% is in traditional and the other 80% is in Roth. It's probably how that shakes out. I wish it was more in Roth, but it is what it is. So I would absolutely prefer to pay the taxes now on that money and then down the road not pay anything when I withdraw money. So that's my thought.
I'm going to show you this. I'm going to walk you through some of this, and I'm not going to tell you what fund to put money in, but I'm going to you'll see where mine is, and then I'll kind of tell you how I came to that decision towards the end and recommend a book that you should read if you want to get better at this, or what you should do if you want to just be hands off, right? And there we are. right? So this is full transparency, right? So since we're being transparent, you're going to see everything anyway. So right now I'm sitting at $79,533.23. Of that, 74.21% is in the C fund, 25.79% is in the S fund. It is set up to where my contributions are 75-25. This just means that the S fund has grown a little bit faster than the C fund, which it has this year. We'll kind of dig through some of that a little bit. And so that breaks out to me having about 60 grand in the C fund and just over 20 grand in the S fund. And then share price, obviously, you see that. So I have 1,000 shares of C fund and 251 shares of the S fund. So this is raw as it gets, right? And then you can see account balance by contribution broken down here, and then contribution summary. So you can see that so far this year, this is what I've put in contributions so far year to date. So this is only counting January, February, $2,500, and that's actually because I dropped it to 30% instead of 60%, which it's back up at now. So that'll go back up. And then, yeah, you can see here that in the traditional account that I've put $21,000 into the traditional TSP because I put a lot in there before I knew what I was doing. And you can see that I've got $50,000 in the Roth, which is where I put the vast majority now, but also the traditional is where the matching contribution goes automatically. So that's your matching contribution will always go to traditional. You can't change that. Service member, automatic, 1% contribution. So you can see right here that I've got by contribution $7,000 ish. That was my 5% match. So this is why you should always do at least the 5% matching. Because that adds up very quickly, and you can even break it down to shares. So this is cool. So for those of you who don't know, to change your contribution, like the amount you contribute, you go to your MyPay account and you can change in there. You go down to TSP contribution, and then you can put 10%, 20%, 30%, and you can pick traditional or Roth. And I've got a lot of videos on this, but the short breakdown is I would say, think of it like this. If you think you're going to make more money in retirement than you do now, Roth. If you think you're going to make more money in now than you do in retirement, traditional. So it's like, do you want to pay the taxes now or later? So if you think you're going to make more money now, then you should pay the taxes later. And if you think you're going to make more money later, then pay the taxes now. So you want to try to pay the taxes in the smaller tax bracket, and then also factor in, do you think taxes are going to be higher or lower by the time you retire? That's the long and short. With the Roth, you pay the taxes up front and you don't pay them later. And with the traditional, you pay the taxes later, you don't pay them up front. And that actually helps reduce your taxable income for the year if you contribute to traditional. But again, it depends on how much you're making. So anyway, go to recent transactions just to show you guys the way around the site. So you can see here. So this one right here, this contribution on January 4th. This is what the 60% contribution looks like when I'm putting 60% in. So it hit $17.97 into C fund, $5.99 into S fund, and then so there's the total $23.96. And then this is the matching contribution that coincided with that. So that's the service member automatic 1%, 29, and then what I contributed as the service member match 159. So $200 essentially is the match. So it's like $2,400 a year. And then this is it. This is when I dropped it to 30% for a month or two, and I increased it back to 60. I'm trying to max it out before I get out. So 1,028. So you can see the difference there. So anyway, so that's recent transactions, account summary. You guys kind of already saw this, but beginning balance of, I guess, October 1st. So you can do this back for a year or whatever. So let's go a full year by March 1st. So as of March 1st to now, my beginning balance was 40,000. So I've grown almost doubled in the last year. And that is because, well, for one, I put 20,000 in, $19,562 in the last year. All right, that's about as good as it gets. That's right at the cap. It's actually a little bit over the cap, but I think that's just because, I don't know. I mean, the new year started, right? So it doesn't really factor. And there's actually, I put a little bit of a bonus in there because I got the 12-year continuation pay bonus, and I put some of it straight into this, like $2,500 or something like that. So you can see that I did an interfund transfer here, which is basically I reset the allocation of my account. It was a little bit too far off from the 75-25, so I reset it. And then you can see that I gained just about $20,000 this year in interest. So it's been, last year was a pretty good year for the stock market, right? And I didn't touch this. I don't move it into G fund when I think the market's going to dip. I just leave it, right? Long term, don't touch it. Pick an allocation and go with it. And then you can dig into statements and documentations and all this other stuff, right? There's all kinds of other things, message center or whatever. So this is where you guys want, right? Contribution allocations. So if you want to change this, so right now I have it set to 75-25. So you hit request contribution allocations, you go over here and you would pick whatever you want. So I'm going to talk about this for just a minute, right? If you are not familiar with the funds at all, or you don't want to deal with trying to figure out what funds are best for you, or you don't want to do the research, pick one of these, right? If you would just want to set this and forget it, pick whichever Lifecycle fund is going to be the year you turn 60 and you can start withdrawing, or the closest to it. They just did these. They used to be every 10 years. Now they're every 5 years, so it's even better. So let's say, like for me, I should turn 60 right around here, 2050. So I would pick Lifecycle 2050, 100%, boom. Easy day, right? Then I never have to worry about it again. Now, if you want to play the system a little bit, if I did 2045, it would be a little bit more conservative. If I did 2055, it would be a little bit more aggressive, because what it does is this fund it shifts. So it's more aggressive as you're younger, as it should be, because you can afford some risk and you can afford some volatility for those bigger gains. Then as you get older, it slowly moves into more conservative, more G fund related allocations, and I'll be able to show you that on here in a minute. I'll show you kind of the difference in the different fund. I'll make sure I do that. So if you want to do what I did and leave it in the G fund, so just for the record, it used to start off in the G fund no matter what. Now it starts off automatically in the Lifecycle fund for your age, so that's good, because this is what cost me literally tens of thousands of dollars, because I left my money in the G fund for like 7 years putting money in. And the G fund never loses money, but it only goes up like 2%. It's basically bonds. It's government-backed securities. Not going to lose money, not really going to gain money. So in a down market, the G fund is safe. In an up market, you don't want to be in it. You want to be in these. And then you can see, so this is international and then small cap. Basically, these mirror like the S&P, which is where my money is right now. And then, yeah. So anyway, so there you go. So you literally just go in here and change. And this will change where your money goes going forward. So if you want to change your future contributions, you go here, you change this, right? And then you hit continue, and it'll be review and submit. Let's see if it'll even let me walk through if I just do the same exact thing. Continue. No. Yeah, so I would have to change it. I don't want to do that. So then you review and submit, confirm, right? So inner fund transfer. This is where you fix it if your funds aren't where you want. So like right here, right now, you go here and you can just put whatever you want. So if I wanted to set this back to 75 and 25, I would just do that. It's not far enough off that I care right now, but I'd hit continue and it would just move the money around to make it back into 75, 25. So if you get in here and you're like, man, I don't like where my money has been going for the last few years, you go to the interfund transfers piece right here. You walk over here and you just put 100% or break it out however you want. The reason I do S and C is because that kind of mirrors the S&P 500. Told you guys I'd mention a book. Read The Simple Path to Wealth by J.L. Collins if you want to learn how to pick these funds. I'm not by any means recommending that you do the CNS fund. That's just what I've chosen. That kind of mirrors the S&P 500 and VTSAX, which is a Vanguard index fund. But it's really going to depend on your own risk, right? Like these are more aggressive funds. This is a more aggressive allocation. I've got friends who do C, S, and I. I've got friends who do a whole mix. There's like millions of different ways that you can allocate these funds. So I recommend that you either read Simple Path to Wealth and learn about these different funds, or you go with the Lifecycle fund if you're not going to go out of your way to choose the right fund for you and whatever, right? The current loan rate is 1.375 if you borrowed money from your TSP, and you can borrow up to $50,000 or half of your value. I could borrow just shy of 40 grand right now at 1.375% interest, which could be great. But if the market's going up in value, you got to factor in how much you're losing in gain, because that money is not working for you while it's out. And then there's a couple different rules, right? I have to have, like you have to be, it's a period of 1 to 5 years, one general purpose loan, TSP loan, like there's all kinds of different rules, and you can request a general purpose or a residential loan, and I'm not going to dig into all that right now. If you guys really want me to do that, let me know. But I generally think that a loan from TSP is the wrong answer. And then you can do, if you want to withdrawals, there's different ways to withdraw. Fund performance. Let's do rates of return. All right, so yeah, that looks good. So here's what you'll see. We do 2020. So the Lifecycle fund, or the Lifecycle income, learned 5.15, and this is, keep in mind, this is 2020. And so these 2025 funds, like the every 5th year, are new, so they don't have the data. 2030 earned 11.6, 2040 13, 2050. So you can see right here, right, these guys are getting closer to retirement, so they earned less because they're less aggressive, earned more because they're more aggressive. And so that's the reason behind this. These 2050 Lifecycle funds are more aggressive right now because they're longer until they get to pull out. Just like this one, I'm sure would be even more aggressive. I mean, you can see it right here. So far in 2021, earned 1.9, earned 2.47. Now, that's great. That also means that if the market downturns, then, they're going to be more exposure. So, and then here we see the G fund, like I said, didn't lose money, never has, but earned only 0.97% last year. So if you had all your money in the G fund, my funds were 18.31 and 31.85. So I almost wish I'd been 50-50, right? Imagine that extra 12% interest I would have gotten, 13% interest I would have gotten if I'd had more money, if it was 75S, but it's not always the same, right? Like S fund earned less here, S fund earned less here. So they vary, right? And then 8.17. So, this year, it varies. So pick a fund, pick an allocation, and then go for it, right? Pick what works for you. Now let's see if I can find, there was a piece that I was looking for about fund options. There we go. Lifecycle funds. There we go. So here you go. So you can see this is 2040. So if you turn 60 in 2040, you see that it's 20% G fund, 36% C fund, 10% S fund, 25% I fund, right? So you kind of see that allocation right there. I was hoping it would just have like a compare button, but you see that, right? There's 20% in the G fund. The vast majority is S fund. Now let's go to the 2060, which should be more aggressive. All right, so 2060 is 50% C fund, 15% S fund, 34% I fund, and literally less than 0.5% in the G fund, right? So this is much more aggressive because this is for people who are retiring in the near future, or in 40 years from now. And Lifecycle 25, so this is people coming up on retirement right now. You see that it's 46% G fund, and then still C fund, still I fund, but much higher concentration in the G fund. And that's because if the market tanks, this won't lose money. So you will only be having like 54% of your portfolio has that risk. And so this will make it much easier for you to weather that. As of July 1st, 2020, there are 10 Lifecycle funds instead of the 5 there used to be. Now, for those of you who don't know, and there's other videos that you should check out, I have videos on TSP strategies and some articles. Lifecycle funds, essentially, they change your allocation of funds as you age towards that target date. And so what you do is you pick the date that you plan on retiring, and then you choose that Lifecycle fund based on when you're going to turn 60 or 70, whenever you want to withdraw your money. And when you're young, it's more aggressive, so it's much more like my current strategy, which is like C fund, S fund, I fund. And as you get older, it gradually becomes more into like the G funds and other bond-related funds, so that if the market crushes, you're not going to lose as much of your portfolio. So it won't gain as much value, but it's not as risky. And so as you get older, that's what you want. You don't want quite as much risk. So I always recommend to people, if you don't really want to know a ton about funds, like if you don't want to spend all the time worrying about it or researching it, or you just can't comprehend it, or you just want something that's completely passive, you never touch, you never change, whatever, the Lifecycle funds are great. But there's been one fundamental issue for me for a long time with them, and that is that they only had Lifecycle fund 20, 40, 30, 50, 60, whatever. So in essence, like for me, it wasn't a big deal because I'm going to turn 60 in 2050. So I could just choose the Lifecycle fund 2050. But say you were born 5 years later, you would be torn between, should I invest in the Lifecycle fund 2055 or 2050 or the Lifecycle fund 2060? And so one of those would put you riskier for a longer period of time, and could pose a risk. And the other would put you more conservative, closer to your, or earlier, which means you might not have as much money in the fund as you get closer to retirement. So kind of a downside, not a huge deal, but the thrift savings plan now has every 5-year increment. So there is a 2025, I think it's actually from 2020. So like a Lifecycle fund 2020, 25, 30, 35, 40, 45, 50, 55, 60, so on and so forth, which means that it's going to be much more accurate. So now you're only going to have to worry about like deciding, 2 or 3 years off one way or the other instead of potentially a whole decade or a half a decade off, which just means that you're getting a better allocated fund for you. So it goes through here and it's got so it's all right. So from 2025, Lifecycle Fund 2025 all the way through 2065 is the new lineup every 5 years. So what I want to do real quick is I just want to show you this. So we're going to use Lifecycle 2060, right? So that's for participants who will withdraw their money. Well, yeah, in between 2058 and 2062. So the objective, high level of growth with a very low emphasis on preserving assets. And then as you shift, so let's do like 2025, to achieve a low level of growth with a high emphasis on preservation of assets. So it shifts over time, right? And you can see the fund allocation over here. And so it's got G, F, C, S, and I funds adjusted quarterly to see how this works. So check this out. This is what I think is cool. Now this one just launched. This one started in 2020. So, there's no like chart right now as of like monthly returns. Whereas if we look at the 2050, they've got a chart over the last 12 months, what they did. You can see kind of lifetime, like the growth of $100 since inception. So this started in 2011. It would be worth $225 right now. Whereas the 2030, which should be more risky, $100 would be worth $256. So a little bit riskier. Anyway, I don't need to get too into the weeds on that. But check this out. Look, this is on the website itself. So you can see right now, 0.43% G fund, 0.57% F fund, 48.5% C fund, 15.5, almost 16% S fund, and almost 35% I fund. So personally, currently I'm at like 75% C fund, 25% S fund. Now, at one point I was C, S, and I. And so either of those allocations is good when you're trying to be more aggressive and grow. But look at this, watch how it shifts. So you hit this button, and you can just see how as it grows closer to retirement date, you'll see the G fund, the orange there, is really growing and becoming a much larger portion of the portfolio, whereas the other funds are slowly dropping. And what that does is when right now, say we're there, 65% of your G fund, that means that if the stock market took a 50% hit, right, just got obliterated, 65% of your money wouldn't have lost $1. So you would have only taken a 50% hit on the other 35% that's in those more aggressive funds. So your hit would be much smaller. So, that's like what, 15% loss over your portfolio, which, if you have $1 million in there, which is very possible, that's still $150K down, but that money will come back, but you didn't lose, $500,000. So it becomes much, much more secure, much less risk. So if you are somebody who doesn't want to deal with their funds or wants it on true autopilot, I suggest you just pick whichever life cycle fund is closest to your target retirement date, put the money in there, and just set it, forget it. Like, you never touch it again. Just continue to contribute into that account, and it'll do the best match of like mixing and matching like high risk, high reward to low risk, lower reward as you age, so that when you can afford those risks, it takes it. When you can't afford those risks, it doesn't. And this works out in your favor no matter what your personality is. So if you are a like high risk or a low risk person who's like super risk averse and can never take risk, if you put it in here, it's going to put you in a more risky fund than you would choose, so you'll get a better return. But then by the time you're older, it's still going to manage or mitigate your risk, right? Whereas if you are a super high risk person like me, who is not risk averse and jumps into things, that's great for me at a young age, probably about what I would be doing. In fact, it's fairly close to my allocation. But as I get older, it'll automatically move money into the G fund. So realistically, I will eventually move all my funds into an L fund once I either no longer want to mess with it, or just want to put it on autopilot, or when I realize that I'm still taking risks I don't need to, and I want to get into like wealth preservation. And I've got a video on advanced TSP strategies you should check out. But this is not to say that you can't go and roll your money into a self-directed IRA later and invest in real estate or do some private lending. There are a lot of options that you can take with your thrift savings plan down the road, right? So there's nothing to say that you can't do other stuff with this money. It's just, I like leaving the thrift savings plan alone as my like super duper emergency fund, because no matter what, this will still be here if everything else fails, so that, you know, even if I only have $500,000 in this, by the time I'm able to retire at a 4% safe withdrawal rate, that's an extra $20,000 a year that I can pull out of it every year for my survival. So an extra like $1,500, $2,000 a month that I can pull out and utilize towards my retirement. So it's a good safety net, which allows you to take a little bit more risk. And if you're smart with this as a young service member and you have listened to some of my other videos, which if you haven't, go do it, you can actually have way more than $500,000 in that account by the time you get towards retirement. Like I said, I would have double or triple in it right now. Hell, I'd be like halfway to half. I mean, anyway, it's sickening to think of what I would have done if I'd known how to use this thing earlier on. But yeah, if I could change anything, like the one thing I would tell anybody who joins the military about their finances is set your TSP up immediately so that if you put 20% in it right off the bat, it doesn't feel like you're losing money every paycheck because you never saw that 20%. But if you start at 0 and then you increase it to 20%, well, now it feels like you're getting a smaller paycheck. So I would say put at least 20%, if not more, into your thrift savings plan immediately when you start getting your paycheck. And the more, the better at an early age. The more you can put in at an early age, the more money you'll have, because the longer that money will compound. So putting in 20% when you're 18 is better than putting in 30% when you're 30, right? Like, if that makes sense. And so the more money you can put away at the beginning, the better, because of compound interest and how all of that stuff works. So the one thing I would tell anybody joining the military is the first thing you need to do with finances is put at least 20 or 30%, you know, the more the better, into your thrift savings plan. Set it up correctly so that the money's going into a decent fund. If you aren't already investing in the TSP or haven't seen my other videos or articles about the basics of the thrift savings plan, you may want to check those out before watching the rest of this, but you'll still get something out of it. So either way, the first strategy is the triple tax deferment. When you enter a combat zone or other tax exempt duty station, you can contribute to your TSP as usual. In fact, you can actually contribute up to $57,000 a year to your TSP while deployed, which is a number that is much higher than your normal limits, $19,000. Since your income will not be taxed while deployed, you could be contributing tax exempt pay into the TSP. As a result, you could be able to avoid taxes when contributing, avoid taxes on your earnings, and avoid taxes upon withdrawal, which just is mind-blowing to think that you could just no taxes at all. I am currently invested in the CNS funds in an allocation percentage that's similar to the total stock market index. Side note on this, like asterisks and stuff, I don't really want to discuss my specific allocation for liability reasons, so I can't give that out, because if you follow it and lose money, then you might say, oh, well, Dave said, so no. Lifecycle funds. If you are not super savvy with investing or don't trust yourself to stay the path during downturns, the lifecycle funds are perfect for you. You simply choose, click, the lifecycle fund associated with the year that you will begin withdrawing, and then you never touch it again, ever. Don't, just leave it. For example, I will turn 60 in 2050. So I would just utilize the Lifecycle 2050 fund, while somebody who plans to begin withdrawing in the year 2055 could use either the Lifecycle 2050 or 2060 fund, depending on your risk strategy. The way these Lifecycle funds work is that they automatically adjust from a more risky allocation to a more conservative allocation as you get closer to withdrawal. The beauty of this is that your automatic contributions will be automatically allocated, and you'll never have to touch your TSP again until withdrawal. So they will adjust based on your age and your risk performance to ensure you get the best withdrawal with the least amount of risk for ever losing money. You just set it and forget it. Timing the market with your TSP. Almost nobody can outpace the market long term. And if they do, it's expensive. It is extremely rare for anybody to consistently outpace the market. Now, even if you do manage to outpace the market, I would be willing to bet that the amount of money you earn wouldn't be worth the amount of time it costs you to earn that little bit better return, especially when you factor in taxes and trading fees. The best thing you can do is decide on a fund allocation and just stick to it. The market will go up and the market will go down. It'll be bullish and bearish and up and down. And if you try to predict this, you will stress yourself out to the max and probably still end up losing money in the long run, even though you were stressing about it. And I would recommend adjusting your allocation no more than twice a year if you feel like you need to mess with it. I haven't touched my fund allocation in over 2 years now. I'm much happier not focusing any time or effort on it than I would be stressing and maybe, just maybe, earning a few extra dollars. Probably lose it. Thrift Savings Plan loans. A lot of people don't realize that you can loan yourself money from your TSP. Just here you go, without paying a penalty tax. You can borrow up to $50,000 or 50% of the total vested account balance, whichever is less. So if I have $50,000 in there, I could borrow up to $25,000. If I have $100,000 in there, I could borrow up to $50,000, if that makes sense. There are two types of TSP loans that you can utilize. The first is a general purpose loan, which may be used for any purpose. There's no documentation required. It's a 1 to 15 year repayment term. The second is residential TSP loans, which is for the purchase or construction of a primary residence. It does require documentation to show that's what you're doing, and it's also got a 1 to 15 year repayment term. There is a flat fee of a whopping $50 that TSP charges for administrative expenses, but it's just subtracted from the amount you borrow. So if you borrow $10,000 with the TSP, the amount paid to you will be $99.50. And the interest rate on your TSP loan is whatever the interest in the G fund is earning on the date that the loan is processed, which is usually anywhere from 1 to 3%, closer to 1 or 2. This loan is set up so that it's a fixed interest rate for the life of the loan and extremely low interest, which is awesome. To top it all off, the minimal interest you do pay on this loan gets repaid to yourself. So if you borrow $10,000 at 2% interest, you'll be paying yourself an extra $200 a year as you repay the loan. That sounds great, but the biggest downside of utilizing the TSP loan is the opportunity cost. Let's say your fund averages an average of 7% increase in value, which is the market average over the S&P 500 for like the last majillion years, whatever. So 7% return. Every year your loan is out of the market. If you are repaying yourself 2% interest, then you've effectively missed out on 5% return on the investment that you would have gotten if you just left your money in there. So you're paying yourself $200 in interest every year, but you would have been earning $700 if it had just been sitting there. For that reason, I much prefer to leave my money in my TSP as my emergency fund all the time, unless I know that my return on investment will be much higher than what I could be earning in my retirement account. And that's gotta be guaranteed or something, right? Like I don't wanna risk it. Now you could roll your TSP into a self-directed IRA. When you exit the service, it will become possible to roll part or all of your money into a self-directed IRA. The benefit of a self-directed IRA is that you control where the funds are invested, and you're just not limited to the stock market. A self-directed IRA can invest in real estate, businesses, or operate as a private lender if desired. There are many advantages to investing with a self-directed IRA, and one of my favorite is that you're in control. You can lend money to a fellow real estate investor, purchase tax liens, conduct note investing, and many other options, and not pay taxes on it. The disadvantages include additional fees and work required. There's very few, if any, funds with lower fees than the Thrift Savings Plan, not to mention that investing in real estate requires a lot more time and effort than simply letting your TSP earn interest by sitting there. Now, I love real estate, but let's be honest, letting your TSP just sit there for 40 years is definitely less effort than just actually having to invest in real estate. So now there's some ways to withdraw your TSP early. One is the substantially equal periodic payments, SEP, which is a method of withdrawing money early from your TSP without having to pay the 10% penalty. SEP can be used in the form of amortization payments, annuitization payments, or the required minimum with distribution RMD. All these methods require it to be a long-term plan. SEP requires that you continue the chosen method of withdrawal for at least 5 years or until you reach 59.5 years of age. If you change the distribution method prior to meeting these required times, you will be hit with the normal 10% early withdrawal penalty. Each of these SEP withdrawal methods uses life expectancy and other factors to determine the amount you may receive. The results are different for each method and they are somewhat complex, but worth looking into if you would like to withdraw your cash without paying the penalty. Now here's the best TSP withdrawal practice. There are several different ways to withdraw money from your TSP, but you must begin taking required minimum distributions no later than April 1st of the year after you turn 70 and a half. You may take partial TSP withdrawals every 30 days, or you can take a full withdrawal. You can choose to withdraw a specific dollar amount monthly, quarterly, or annually, and you can indicate this decision when you complete your withdrawal request. You can also take lump sums and withdraw money here and there for large purposes if you desire. So you could say, I need $10,000 to fund my car, whatever. You can even have the TSP compute a payment amount based on your life expectancy too, and they will just pay you out that much, and hopefully you're dead by the time the expectancy runs out, or you're not gonna have any money. If you have monthly expenses that you would like to cover, you could consider purchasing a life annuity, which is a monthly benefit that is paid to you every day for the rest of your life. You aren't required to use your entire TSP account balance to purchase the annuity, but the minimum is $3,500. Okay, you might be thinking this is confusing. Yes, it is, and I tried to just wave top as much as I could. Be sure to consult with a tax professional and the TSP personnel to ensure that you're making the right decisions. The beauty of the Thrift Savings Plan is that it can grow to become a huge, valuable asset with a ton of different ways to pay out and support your lifestyle in retirement. Just understand your options so that you know which way is the best way to utilize it as it grows. I personally love the TSP, if for nothing else, then because it creates a wonderful, wonderful way to have reserves for properties. So your TSP counts as cash reserves towards real estate investments, and so you can leave it there as your emergency fund. So say I have $50,000, we know I can pull 25 for a loan, but I can pull all of it at a 10% penalty. And either way, if something goes really bad with my real estate, this will cover all of my expenses. Ultimately, the TSP loan is a pretty cool benefit for service members if you understand the best ways to use it. And honestly, I don't, we're gonna dig into this, but it's not always the best way to borrow money. Now, there's two types of TSP loans, general purpose and residential TSP. And the general purpose can be used for anything at all, requires no documentation, and has a repayment period of 1 to 5 years. The residential TSP loan can be used for the purchase or construction of a primary residence, does require documentation, and also has a repayment period of 1 to 5 years. For the residential TSP loan, there are a lot more rules than with the general purpose. So you can only use a residential loan for purchasing or constructing a primary residence, which may include any of the following: a house, a townhouse, a condominium, shares at a cooperative housing corporation, a boat, mobile home, a recreational vehicle, but you cannot use a residential loan for refinancing or repaying your existing mortgage transaction or construction of an addition to your existing residence. Renovations to your existing residence, buying out another person's shares in your current residence, these are just all things that you can't use it for. Oh, you can't purchase land, and only your primary residence must be purchased in whole or in part by you or your spouse. All right, now who is eligible to take out a TSP loan? I opted to take this answer straight out of the TSP.gov website, so bear with me as this may sound a little bit legalese, but look, you've got to be an active federal employee or member of the Uniformed Armed Services. You must be in a pay status because repayments are set up as payroll deductions. You can only have one outstanding general purpose loan and one outstanding residential loan from any one TSP account at a time. You must have at least $1,000 of your contributions, your own contributions and earnings in your account. And then agency and service contributions are and earnings cannot be borrowed. Has to be your contributions up to $1,000, and then you must not have repaid a loan of the same type in full within the last 60 days. If you have both a civilian and a uniformed account, the 60-day waiting period applies separately to each one. You must not have had a taxable distribution of a loan within the past 12 months, unless it was due to you leaving federal service, and then you must not have a court order against your account. I think that pretty much sums up everything that the TSP website says. So as long as you're doing that, then you're good. How much money can you borrow, right? So the minimum you can borrow is $1,000. The maximum you can borrow is either the half of your own contributions or $50,000, whichever is less. So if you've contributed $100,000, you could take out $50,000. If you've contributed $50,000, you can only take out $25,000. How do you repay your TSP loan? You're going to have to begin repaying within 60 days, but there's no need to stress too much about this because loans are repaid via payroll deductions, meaning that if you're an active duty service member earning $4,000 a month base pay, you take out a TSP loan that has a monthly repayment amount of $1,000 a month, you will only receive $3,000 a month in base pay until the amount is repaid because they pull it straight out of your checking account or your paycheck before you ever see it, which
honestly does make this a little bit simpler as far as the repayment goes. Pros of utilizing the TSP loan: despite what I'm going to tell you in the cons section, the TSP loan is a pretty good product. Now, there are definitely some pros associated with it, and we're going to talk about those real quick. So the first one is quick access to cash. Once you successfully complete the TSP loan application, you're going to receive funds within 7 to 10 business days via a check in the mail. Yeah, I don't know why they're not doing ACH or electronic deposits at this point in time, but it is what it is. 7 to 10 days is really quick funding, so that's awesome. Second, the TSP loan is a very low cost loan. So there's a $50 fee charged for administrative purposes, and then that's deducted straight from your loan. So if you borrowed $50,000, you would actually receive a check for $49,950 because they would take that $50 out and then send you the remainder. Your interest rate for repaying the TSP loan is whatever the G fund was earning on the date that your loan is processed. So currently, on February 19th, when I wrote the article for this, the current interest rate repayment was 1.875%. That was the G fund rate at the time, which consequently is also why the G fund is not necessarily where you want to invest all your money unless you're close to retirement. The loan interest is not taxable, but it goes back into your TSP balance. So you're essentially paying yourself that interest rate. And then flexible use. So it's unsecured. Ultimately, if you want to use the general purpose loan, you can pretty much do anything you want with it, and that opens a lot of opportunities. But it also means you can buy stuff you shouldn't with it. So you still need to make sure that you're using the funds wisely. And there are several cons to borrowing this money, so we're going to dig into those right now. All right, now here is where I attempt the super difficult task of ruining this loan for you, despite all of the above reasons that it is actually a decent product. The problem is that most of the reasons it isn't great are completely intangible, but trust me, they're catastrophic, or can be catastrophic. Tax implications if you're borrowing from a traditional TSP, right? So a commonly overlooked issue with the TSP loans are the additional taxes you're going to be paying on that money. Consequently, this is the one and only, I think, tangible reason that a TSP loan is not the best way to borrow money. So it is what it is. Now, show of hands, who doesn't love being taxed multiple times? Oh, yeah, me. Okay. So when you contribute to the traditional TSP, you are contributing with pre-tax dollars, right? However, when you're repaying the TSP loan, you're going to be doing so with post-tax dollars. That erases the entire benefit of the original TSP contributions in the first place, because the whole goal was not to pay taxes on your contributions. Now you're repaying with taxes on your contributions, i.e. paying taxes on your contributions. To make matters even worse, because the traditional TSP is taxed on the back end and contributed with pre-tax dollars, you're going to get taxed twice on that money. Because think about it, if you repay the loan with post-tax dollars, meaning you already paid taxes on it, and then the traditional TSP is taxed at withdrawal, and guess what? You're paying taxes the second time on that money, right? That's a bummer. That's why the Roth is awesome, because at least you're not getting taxed on the back end, and you already contributed with post-tax dollars, but you're contributing with post-tax dollars a second time, so still a sucker. It's a taxable event if you fail to repay the TSP loan. So here's another fun con. If you fail to pay the loan back, the IRS will view it as a taxable withdrawal of funds, which means that you will be assessed an instant 10% penalty in taxes that you owe the IRS. Talk about a fun bonus to have your loan costs suddenly jump up 10% immediately, and by the way, the IRS doesn't really care about you repaying over time. They're going to want that money up front. Opportunity cost. Okay, so I'm going to paint a picture for you. Let's say you took out a loan for $10,000 in January of 2021. And let's assume that the interest rate was an easy 2% and you repaid it in full in exactly 12 months with your monthly payments, right? Clockwork. Everything went smooth. Now, in the above scenario, you would have paid yourself $200 in interest for a total of $10,200 paid back to yourself. Now, what if I told you that money could have earned over 40% ROI if you just left it in the TSP? I know it sounds crazy, but in 2021, which again, albeit not a normal year, but in 2021, my personal returns in the TSP were 44.61%. So in the scenario with 40%, your account would have grown by $4,000. So by taking the TSP loan, your balance at the end of January 2022, 12 months from the inception, would be $10,200 back into the account, as opposed to $14,000 in the account. Now, the TSP loan actually cost you 38% in return on the money that was sitting there in opportunity cost. Now, obviously, the argument here is, well, Dave, what if the market goes down while I have the loan out? And you're correct. However, historically, over time, markets generally trend up over time, and attempting to time the market is just a losing game. But trying to time the market on the bad end is just not worth it. Ultimately, you need to understand that there's a really good chance the TSP loan will cost you a lot more than the interest rate you're repaying. So that's just something you need to be okay with. And then also here, the risk of ruin. So I view my savings plan as my super duper emergency fund that I will only touch in a worst case scenario. For example, in March of 2020, when COVID first started to wreak havoc on landlords, I was able to look at the balance and say, well, worst case scenario, I have enough money to pay all of my mortgages for 18 months, even if my tenants don't pay me a penny. In my opinion, you can't put a price on that security, and you lose that if you borrow from the balance, right? So, especially if you don't repay it. Also, the TSP fund is your retirement fund, so you're essentially borrowing from your future self in order to fund your current life cycle. So you need to make sure, like absolutely certain, that you're not assuming a risk that could wipe out your loan amount and then harm your future self. So you should just never assume the risk of ruin. So make sure if you're using this, it's either like a worst case scenario or some incredible opportunity that like is actually going to pan out, not a huge risk. All right, bottom line, should you use a TSP loan? Ultimately, that's going to depend on what you're using it for and your confidence in the ability to repay that loan. Here are my thoughts though, as a rule of thumb. If you need to take a personal loan, the TSP is a simple and efficient way to do that. If you have an emergency arise, the TSP loan is a decent option for digging yourself out of that hole. If you're just looking for a TSP loan to buy an investment, I would caution you to think through all of the indirect costs and the risks associated with borrowing these funds. It's probably not your best option. And for the record, just yesterday, I told somebody who was about to withdraw $50,000 from their TSP and lend it to me to help fund a deal that I didn't think it was the right move for them. So I'm not just saying this as like you shouldn't do this. Like, I genuinely think that had he done that, he would have actually lost money through opportunity cost over what I was going to pay him in interest. And it just doesn't make sense, right? I don't want to be a part of that. Also, I really do believe that time in the market is one of the most important things to maintain with your thrift savings plan. So look, the bottom line is this. I promise you that there are better ways for you to borrow money out there, and I really hope that you look through those before you jump on the TSP loan, because it's not always the best option. It's a great option in its own right, but I don't like the idea of taking it out to buy things that aren't sure investments, right? So just make sure you know what you're doing. There are chances and times where this absolutely makes sense, but I err on the side of caution with basic finance, and then I like leverage and risk on big loans.
What you should do with the thrift savings plan after exiting the military, and it just more and more frequently. Now, while my default answer is nothing, leave it alone and benefit from the compound interest and knowing that your future is secure, I understand that there are a lot of different alternatives that could prove to be worth your time. So in this video, I want to explain what some of these options are and why it may or may not be beneficial for you to roll your thrift savings plan into these investment vessels. Now, keep in mind that I'm not a licensed financial advisor. I'm just somebody who's done a lot of research, and also these are just my opinions, right? So be sure you do your own homework and you come to your own conclusions as well. On the other hand, keep in mind that I will not receive a commission of any type from you rolling your TSP over, but many people do. So always remember to ask yourself what filter somebody is using when they're selling you on the idea of rolling your TSP into a specific asset class, because they just might be incentivized by a commission payout to recommend it to you, and you just, you need to know that. So should you roll your TSP into, whatever, here we go, right? So when you move funds out of your thrift savings plan and into another asset class, it is referred to as rolling your TSP over, as kind of slang. I'm sure it's referred to a bunch of stuff, right? So should you roll your TSP into a Roth IRA? And it seems only natural that the first type of account you might consider rolling in your TSP into is a Roth IRA. After all, the Roth TSP and the Roth IRA are essentially the same asset class. Now, the main difference are the contribution limits, as are much smaller with the civilian Roth IRA than on the thrift savings plan, roughly like $6,000 instead of $19,500, which is quite significant. That being said, the reason that I'm not a fan of this idea is twofold, right? The first is that the Thrift Savings Plan has extremely low fees. It's a tough to beat program, and the fees associated with rolling your TSP into a Roth IRA will hurt your long-term return greatly over time, because when you roll, there's always fees that come associated with, that act of rolling your TSP over. So just know that that will take a hit to what you have. Now, ultimately, the main reason people do this is because somebody is selling a new Roth IRA product, and that person will probably receive a commission for doing so, or because you prefer to have all your money in one IRA account, which I understand, because having, that money consolidated feels good, but paying the fees to roll it over just for that reason is a poor financial decision if you do apples to apples, right? If you have to pay a 10% fee, then, long term, that's hurting you. So that's my thoughts on the IRA. I personally would just keep my TSP and then open a Roth IRA as well, and I have several friends who do that. Now, should you roll your TSP into a self-directed IRA? A self-directed IRA is an individual retirement account that allows you to invest in all sorts of asset classes. You can use the SDIRA to purchase art, precious metals, private lending, equipment, and many other things, including real estate, which is why a lot of people actually enjoy rolling this stuff into the SDIRA. Now, real estate is the most common reason that I see people wanting to open a self-directed IRA, and I'd be honest, I can see the appeal here. While all of your profits would need to be rolled back into the self-directed IRA, there's still an allure of investing in real estate through the SDIRA, through private loans, or through buying property yourself. That being said, one of the reasons that I like the Thrift Savings Plan is that it's a diversification from my real estate investments. I don't believe real estate is the only way to build wealth, and I think it would be foolish to believe that, right? Like, I personally prefer to have my money in multiple asset classes, and the Thrift Savings Plan is a good diversification from real estate. So personally, if I ever do end up rolling my TSP into anything, it would most likely be a self-directed IRA, because I want to have control over those funds. Now, that being said, I don't have any intention of rolling it over just yet, for a couple of reasons, right? The first, I don't want to pay any unnecessary fee to roll my self-directed IRA, because that hurts your long-term gains, right? If I had to pay $6,000 to roll it over, that's $6,000 I'm no longer earning interest in. Now, I like having diversification in my portfolio, as I mentioned. Also, you can take a loan personally from the Thrift Savings Plan, not from a self-directed IRA. Now, I don't condone that, but that could come in handy if you need the money for something briefly, but you don't want to pay the taxes and fees and other penalties and all that other crap on it. So the self-directed IRA is an alluring investment strategy, but you need to be a very savvy investor before you mess with this. So you need to know how you plan to use the self-directed IRA before you even think about rolling into, your TSP into one. So that's kind of my thoughts on that. Also, I don't know that I recommend rolling it over just to invest in the same asset class. Keep that diversification. Should you roll it into a whole life insurance policy, the infinite banking concept? Whole life insurance has become a popular investment strategy over the last few years. Now, I use quotation marks there because I would consider it more of a saving strategy than an investment strategy. That's not how people are teaching it right now. Look, if you want to understand more about my thoughts on whole life insurance, I wrote an article about it. There's a video about it as well. Suffice it to say that there are a lot of people talking about how great these are, and a lot of those people get paid a large commission to sell it. So find someone who's not getting paid to sell it if you want to have that conversation. Whole life insurance can be a great strategy if you have the money to overfund it, which the Thrift Savings Plan actually might. If you have enough in there, it could be that metric to overfund. And then, if you do that right off the bat and you have it set up properly, you might have some pretty good benefits with it. Now, there are mediocre insurance reps out there, so you need to make sure that you do your homework and you ensure you're setting it up the right way if you're going to use this investment strategy. So ultimately, this would probably be the second place that I would roll my Thrift Savings Plan, but only if it aligned with my long-term goals and I was able to set it up properly. Now, I don't foresee that happening, and I would caution you to really think about this before doing it. Not to say that whole life is a bad investment decision or savings decision, whatever, but to say that the Thrift Savings Plan is a great investment strategy, so why give it up for a saving strategy? All right, should you roll your TSP into property? And obviously, just close it out and buy property. So I see many people talking about closing their TSP completely to invest in real estate. Now, I love real estate as much as the next guy, if not more, but I don't like the idea of paying exorbitant taxes and fees for closing down my Thrift Savings Plan just to buy real estate. Now, I think you would be much better off leaving the money alone, saving it in another stack of cash or whatever to invest in real estate, and keeping the thrift savings plan as another option, right? So maybe, just maybe, you should just leave it in the thrift savings plan. All right, now, should you roll the thrift savings plan into the thrift savings plan? All right, maybe. Look, hear me out. Maybe, just maybe, you should just leave it in the thrift savings plan to grow. So I view the TSP as my super duper emergency fund. So when the pandemic hit in early 2020, I was able to look at my thrift savings account balance and know that if I had to pull it out, even after fees, or pull a loan from it or whatever, I could cover 100% of the vacancy rate in all of my rentals for 18 months if I had to. Now, to me, the security of knowing that I can weather some really large storms because of my TSP is worth leaving it untouched instead of investing it somewhere else and then not being able to use that money. Now, unless I absolutely have to, I don't plan to mess with it. Now, also, that little nest egg is going to continue to grow to over $1 million by the time I'm 60 without any effort from me at all, completely passive. Now, hopefully, I'll never need the money, and even when I reach retirement age, and I'll be able to give it to my kids or use it for whatever else I want, but it's better to be safe than sorry, and so I plan to leave my TSP alone to just compound interest and let the compound interest work its magic, right? So what should you do with your TSP after the military? That depends. I mean, that depends on your long-term goals. It depends on your level of risk aversion. It depends on your investment strategy going forward. It depends on what asset class fits your personality, right? So make sure that you understand the ramifications of any taxes or fees or penalties that you'll have to pay when you utilize your TSP funds for anything other than the thrift savings plan. Also, I recommend that you cross-check the advice that you're getting from these, with unbiased sources and people who aren't getting paid based on what you do with the money, right? Because nobody's going to look after your interests more than you will, and you need to always remember that. I'm not saying that they're giving you bad advice, but just know that even if their intentions are good, if they're highly incentivized to kind of nudge you this direction instead of this direction, they will, because that's human nature, right? You're obviously going to be inclined to believe in the vessel that gets you more of a return. Not saying that it's intentional or shady. That's just how things work. Somebody screenshot a post that was made in there where someone shared my book and basically just said, oh my God, I really wanted to like this book, but Dave said Lifecycle funds are okay and I can't stand behind that terrible advice, blah, 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 whatever. I don't know. Who wants opinions when you could just speak whatever you want in a vacuum and not have to worry about ever being told you're wrong. So the first thing I would say to that is they clearly either didn't read the entire chapter or just weren't paying attention, because I don't recommend that people put their money in Lifecycle funds. That's not my game. My money is not in a Lifecycle fund. What I recommend is that people either do their own research, understand the funds, the allocations, the contributions, all the things, and know what they're doing, like know what your allocation's actually invested in. Or yeah, the Lifecycle fund is a better option than not knowing and just gambling. Because for the last however freaking long until 2020, when we went to the blended retirement system, money started out in the G fund, which is basically like government-backed securities. So it never loses money, but it doesn't go above like 2 to 3% return, which is not outpacing inflation and it's not great, and really it's just not the right place. The only time that G fund makes sense is if you're close to retirement, so you want that low risk, or if you are like, I guess if there was a recession, but I don't believe in timing the market, so you're not going to know that, and then you're going to miss the timing and you're going to miss out on gains closer to retirement, right, when you're trying to play it safer, which the Lifecycle fund does. The Lifecycle fund starts off very aggressive, and as you get older, it progressively moves to more conservative, so that if a recession hits 2 years before you can start withdrawing, your money won't take as much of a dip, because you can afford to have your money drop and go up, then drop and go up at a young age and have more risk and more likelihood of return on investment. At a older age, that's just not the case. The risk is, you want to mitigate that risk, lower that risk, and you want to be able to, weather a storm and not have like a massive drop right before you need to use that money towards retirement. So that's kind of my idea, right? Either invest in yourself and learn how to utilize all this stuff, or the Lifecycle fund is better than the G fund, or just choosing a fund blindly without any idea what it is and not paying attention to it. Personally, I'll tell you that I'm in 75% C fund, 25% S fund. At one point, I was 70 C fund, 20 S fund, 10 I fund. Both of those are fine. They're a little bit more aggressive. They closely mirror, and the 75-25 more closely mirrors the VTSAX, which is Vanguard's like flagship model for index funds. It is the total stock market index. So that's what I want. I want total stock market, so that I am betting on the entire economy of the United States. I think long run, that's a really good bet. And if that bet turns out to be wrong, like wrong, well then any investment you would have made, it doesn't matter, you'd be screwed. So I like to bet on the entire economy in one broad stroke. Total stock market fund, every company, it's wonderful. Now, on to this other thing. So, the seasonal group tries to say, and they've got some evidence for the last 10 or 20 years or whatever, that if you change funds at different times, historically, your return will be better. It'll be higher, average, whatever. The problem with this is that, like anything, for one, your fees are a little higher as you're bouncing between funds because there's transaction costs and, maybe depending on which fund you're in, maybe some tax ramifications, but not really on the TSP side so much as like index fund side. But the reality is, like, if you look at the data historically, no matter when you started investing in stock market, if you invested the same amount every month, long term, always, you would have returned much better. We'll just use the S&P 500, right? You will have gotten a much better return than if you tried to game the market in any case, right? Like, nobody outpaces the market long term. The people who are like the absolute best professionals in the world outpace the market once in a while, and then they don't. And even if they keep tabs and they outpace the market once in a while, the fees and fee structure and everything for that actively managed account eats away at it, and you're probably still net zero or net loss compared to if you just dollar cost averaged into the S&P 500 and let it roll. Trying to time the market is a losing game. You have to time it on both ends, right? So you have to time exactly when the market's gonna drop. So you got the perfect peak, because if you pull too soon, you missed out on some potential gains. And even if it drops, it might not drop as far as where you pulled out. And if you pull too late, it's already dropped, and now you've lost. So if you sell then, you're bad. So you have to time it just right at the top and move it into the G fund. And then you have to be ready, willing, able, and continually paying attention to try to time it just right to when it goes back up in order to reap that benefit. The odds of that happening and you being right about it are so slim, and the amount of effort and energy you got to put into it, it's ridiculous. So yeah, no, I don't buy into the whole TSP day trading. The beauty of the TSP is that you can choose how much you want to contribute, choose what fund you want it to go to, and then never touch it again. And it just automatically happens. And it grows, and it grows, and it downs, and it grows, and it ups and downs, and ups and downs. And long term, it grows. And you become very wealthy, and you do very well, and you can live off of it, and it's a great retirement plan. And you pretty much spent no effort on it. The one thing that I do, every month I look at my TSP just because I calculate my net worth at the first of every month. So I look at it just to see where it's at. Outside of that, the only thing I do is if the percentage gets off, I'll rebalance. So I contribute 75 and 25. If the 25 grows much faster than the 75, and so it's like 27% and 73%, then I will balance it back to 25, 75. Maybe once a quarter, once every 6 months, maybe even just once a year. I don't know. I mean, it's rare that balance goes off by a full percentage.